Hi everyone, this is Simran Kaur from HR team of mastertrust, and welcome to the latest episode of our exclusive webinar series Street Experts. Today we are having an exciting session on taxation of capital gains and tax wellness with our guest expert, Ms. Megha Jain. She is from cleartax as she's working there as a tax expert. We'll have a Q&A session at the end of the presentation. In case of any query, please write it down in the Q&A box or raise your hand for the query and we will allow you to speak. So for starting the session, I'm handing over the call to the speaker, Ms. Megha Jain. Thank you.
Thank you so much. Hi, good evening, everyone. This is Megha here for your tax expert for the evening. So today, as you know, we are going to discuss taxation of capital gains and also tax wellness. That is, something around the new tax regime, which currently, as we all know, has become the default tax regime for assessment year 24-25 onwards. We will discuss some hygiene points, some points which are very unique to the new tax regime, and how can a user make most of the new tax regime and also ascertain which regime may be more beneficial to them. So this is a question that most commonly comes up. So we will try to, cover all this in the session. And towards the end of the session, we will have a Q&A. So during the session, if you have any questions, please feel free to put them on the chat board. And I request the audience, please do not unmute themselves during the course of the session, because that will go ahead and break the flow. Please put your questions in the chat box and we will address all the questions at the end during the dedicated Q&A. So now, without much ado, let's start the session. So this is the agenda wherein we will be discussing the nuances of capital gain taxation, along with also discussing what is a capital gain, what is a capital asset, and what are the tax saving opportunities a taxpayer has in case they have long-term capital gains. Then any amendments which may be relevant to note down. So first up, let us understand what a capital asset is. Now, a capital asset refers to property of any kind that is held by the assessee. An assessee means a taxpayer, but it excludes stock in trade, raw materials, and any movable property which is held for the personal use of the assessee. For example, apparel, mobile phone, furniture, laptop, etc. However, there are exceptions to this rule as well. So there are certain items of personal use which are taxable as capital assets, and they are jewelry, drawings, paintings, or any work of art, sculptures, archaeological collection, etc. So in a nutshell, if I have to explain what is a capital asset refers to property of any kind held by the assessee, but it excludes stock on trade, raw materials, and movable property. However, there are certain items of personal effects which are included. They are jewelry, drawings, paintings, work of art, sculptures, and archaeological collections. Now, let us talk about capital gains and the tax thereon. So, any profit that an assessee makes by way of selling any of the capital asset that we have just discussed, whatever are the gains, they are known as capital gains. Now, depending upon the period of holding, whether you are holding the asset for whatever time you have, the asset can either be categorized as a long-term capital asset or a short-term capital asset. Now, depending upon the nature of asset, the gain also go along. So if it is a long-term capital asset, the corresponding gain will be taxable as long-term capital gains. Similarly, if it is a short-term capital asset, the corresponding gain will be chargeable to tax as short-term capital gains. Now, when we talk about transfer for the purposes of tax means either sale, exchange, or relinquishment of an asset. Now, relinquishment means giving up an asset, or lastly, extinguishments of rights. So if you are enjoying any right in a particular asset and the right comes to an end by way of the condition of the contract, then it is known as extinguishment of the right of an asset. Now, when we talk about capital gains on various class of assets, these are the class of assets that we are talking about. Listed equity shares. So listed equity shares refers to any share that has been listed on the stock exchange. Then we will also go on to look at mutual funds, specifically equity-oriented mutual funds, then unlisted shares, immovable asset, and jewelry. So when we talk about listed equity shares, the holding period is 12 months. That is the cutoff. So if you're holding any listed equity share for more than a period of 12 months, it will be categorized as a long-term capital asset. And for a long-term capital asset, the rate of taxation will be 10%. And such gain will be known as long-term capital gain. On the other hand, if you're holding the listed equity share for a period less than 12 months, it will be categorized as short-term capital asset, and short-term capital gains will be chargeable to tax at the rate of 15%. Now, talking about equity-oriented mutual funds, once again, similar to listed equity shares, the holding period cutoff is 12 months. If you're holding equity-oriented mutual funds for a period of more than 12 months, it will be chargeable at the rate of 10%. On the other hand, if you're holding it for a period less than 12 months, it will be taxable at the rate of 15%. Next up, we talk about unlisted shares. Now, unlisted shares refers to any shares which are not listed on a stock exchange. So, primarily, it refers to shares of an unlisted company or a private company. And it also includes those shares which are listed on a foreign stock exchange. So, if you have any shares or if you're investing in shares which are listed on a foreign stock exchange, or if you're getting ESOPs of a foreign company or RSUs, which is restricted stock units of a foreign company, all of these are categorized as unlisted shares. Now, the cutoff period for unlisted shares is 24 months. If you hold any unlisted shares for a period more than 24 months, then it will be categorized as a long-term capital asset and chargeable to tax at the rate of 20%. However, it is to be noted that in case of unlisted shares, indexation benefit is available. Now, one may ask, what is indexation benefit? Indexation benefit refers to a computation mechanism by way of which inflation is accounted for to the purchase value of the asset and it is brought at par with the current rates. Let me give you an example. Let us say you invested in the shares of a private company 20 years ago in the year 2004. Now, at that point in time, you purchased the shares for a meager sum of rupees 1 lakh. However, today, as we all know, applying the concept of time value of money, that 1 lakh will not hold the same value. Its value must have increased. So, by applying indexation, we bring that 1 lakh rupee at par with the monetary value it holds in the year 2024 and then go ahead to do the capital gains computation. Now, if the unlisted shares that you hold are for a period less than 24 months, it will be categorized as short-term capital asset and slab rate of taxation will be applicable. Next up, we talk about immovable asset. This includes your land and building. So again, the holding period cutoff here is 24 months. If you're holding any immovable asset for a period of more than 24 months, it will be regarded as long-term capital asset and tax will be charged at the rate of 20%. Similarly, if you're holding that immovable asset for a period less than 24 months, it will be categorized as short-term capital asset and chargeable on a slab rate basis. Lastly, we talk about items or capital assets of personal effect. So here we have taken an example of jewelry, but it also includes any other personal asset that you're holding. For example, archaeological collection, drawings, etc. So the holding period cutoff is 36 months. If you're holding the asset for more than 36 months, it will be categorized as long-term capital asset, chargeable at the rate of 20%. If you're holding it for a period less than 36 months, it will be categorized as short-term capital asset, chargeable to tax on a slab rate basis. Now we talk about computation of capital gains. How is it computed? We first start off with the sale consideration. From the sale consideration, we reduce the transfer or the selling expenses. So that refers to any amount that you have incurred directly for the purposes of selling the asset. That amount will be reduced. Then what we have is known as the net sale consideration. From the net sale consideration, we reduce the cost of acquisition or the indexed cost of acquisition wherever applicable. Next, we reduce the cost of improvement. And lastly, we have what is known as capital gains. Now, let us take a look at the tax saving opportunities for long-term capital gains. Now, please remember, first up, tax saving opportunities are available only if it is a long-term gain. If it is a short-term gain, no such opportunity is available. Firstly, any long-term capital gains that arise from the sale of listed equity shares or equity oriented mutual funds are tax free up to rupees 1 lakh. So that is to say, if you have sold your long-term equity shares or equity-oriented mutual funds, then the gains arising from such sale up to rupees 1 lakh will be fully exempt. Any gains over and above rupees 1 lakh will be chargeable to tax at the rate of 10%. Next up, the other avenues for tax saving can happen utilizing the provisions of Section 54, Section 54F, and 54EC of the Income Tax Act. So let us talk about each of these sections. First up, under Section 54F, we talk about capital gains arising from the sale of house property. So if you have sold a house property, whatever is the amount of capital gains, that can be mitigated by investing such capital gains for the purposes of either purchase or construction of another house property. Please remember here, the gains must arise from sale of house property and it must also be used for purchase or construction of another house property. Then we talk about Section 54F. Here we talk about capital gains arising on the sale of any long-term capital asset. So earlier we only spoke about house. Now we talk about any other long-term capital asset. So such gains again can be mitigated by investing the entire amount of sale proceeds either for the purposes of purchase or construction of another house property. Now, if you carefully look, there is a very subtle difference between the two sections that we've just discussed. In the first case, it was capital gains from sale of a house property. In the second case, it was capital gains from the sale of any other long-term asset. In the first case, you had to invest only the amount of capital gains. However, in the second case, you have to go ahead and invest the entire amount of sale proceeds to go ahead and gain the capital gain exemption. Lastly, we talk about Section 54EC. Now, under Section 54EC, if you invest capital gains in either specified bonds, for example, rural electrification bonds or NABARD bonds or any such bonds which have been specified for the purpose, then capital gains up to 50 lakhs can be exempted. However, please remember, if you are investing in any of these bonds, they come with a lock-in period of 5 years. That is to say, you must continue to hold on to the bonds for a minimum period of 5 years. If you decide to sell the bonds during the lock-in period, then whatever is the amount of investment that you have done, that will be chargeable to tax in the year of sale. Moving on. Now we talk about the amendments with respect to capital gains, which are valid from 1st April 2023 and very relevant for the current assessment year, which is assessment year 24-25. First up and the most important, going forward, that is from 1st April 2023, sale of any debt-oriented mutual fund or market-linked debenture will now always be categorized as short-term gain only. Irrespective of the period of holding, they will be categorized as short-term asset and consequently the gain at the time of sale will be regarded as short-term capital gain and the taxation will happen in a slab rate mechanism. Next up, the maximum amount of exemption under Section 54 and 54F has been curtailed with effect from 1st April 2023. From 1st April 2023, the maximum amount of exemption one can claim by investing in a house property either by way of purchase or construction shall be limited to rupees 10 crores. And wherever the cost of property is exceeding 10 crores, the exemption will be restricted only to rupees 10 crores. Anything over and above 10 crores will have to be offered to tax. So with this, we come to an end of the presentation with respect to capital gain taxation. Now we will go ahead and analyze what are the tax changes with respect to the new tax regime. What are all the highlights? So let us understand the highlights. The first and the foremost, from the current assessment year onwards, the new tax regime has become the default tax regime. So that is to say, if the taxpayer has not exercised their option of choosing between the regimes when the employer window opens, then automatically the month-on-month TDS and the month-on-month calculation of income will happen under the new tax regime itself. However, if you're a salary taxpayer, you will always have an option to switch between the regimes at the time of filing your return of income. Secondly, from the year 24-25 onwards, standard deduction of rupees 50,000 has also been extended to the users of the new tax regime. So if you're a tax filer opting for the new tax regime, you can go ahead and claim standard deduction of rupees 50,000. Next up, rebate under Section 87A has been hiked only under the new tax regime from 12,500 to 25,000 rupees. Now, please remember, this change is only for the new tax regime. Under the old tax regime, the amount of rebate continues to be 12,500. Now, if a user has opted for the new tax regime and his salaried income is up to rupees 7.5 lakhs, then utilizing standard deduction of rupees 50,000 and rebate under section 87A of up to rupees 25,000, zero tax will be payable. Now, how do we do this? We will discuss this at a later point with an example. But currently, let us take a look at the highlights. Surcharge under the new tax regime has now been reduced from 37% to 25%. So, if you are a person who has opted for the new tax regime and your income is about 2 crore rupees, the maximum amount of surcharge will be restricted to 25%. Lastly, the concept of marginal relief has been introduced under the new tax regime. So, this states that if the income of a salaried individual is between 7.5 lakh to 7,77,778 rupees, whatever is the additional amount of tax flow, it will not be based on tax slabs, but it will be based on the amount of income exceeding 7.5 lakhs. Do not worry if you're getting overwhelmed by the concept of marginal relief. We have a slide explaining the numerical working for your use. But before that, let us take a look at the tax slabs. So the tax slabs for assessment year 24-25 are as under. Under the old tax regime, income up to 2.5 lakhs is not taxable. Income between 2.5 lakh to 5 lakh is taxable at the rate of 5%. 5 to 10 lakh is chargeable to tax at the rate of 20%. And income above 10 lakhs is chargeable at the rate of 30%. The applicable rates of surcharge are 10, 15, 25, and 37% with a cess of 4%. Now, moving on to the new tax regime, income up to rupees 3 lakhs is not taxable. 3 lakh to 6 lakh is chargeable to tax at the rate of 5%. 6 lakhs to 9 lakhs at the rate of 10%. 9 lakhs to 12 lakhs at the rate of 15%. Lakhs to 15 lakhs at the rate of 20%. And income above 15 lakhs is chargeable at the rate of 30%. The applicable rate of surcharge are 10, 15, and 25%, followed by a cess of 4%. So now, if you remember earlier on, I said, if you're a salary taxpayer, under the new tax regime, income up to 7.5 lakhs is not chargeable to tax. Let us understand how. First up, we have income from salary, 7.5 lakhs. Then we do a standard deduction. So now we are left with gross total income of 7 lakh rupees. So now, because there are no deductions under the new tax regime, we take total taxable income as rupees 7 lakhs. The taxation is as follows. Income up to rupees 3 lakhs is not chargeable to tax. 3 lakhs to 6 lakhs is offered at the rate of 5%. So 15,000 is the tax payable. And then income between 6 lakh to 9 lakhs is chargeable at the rate of 10%. So that comes up to rupees 10,000. So now the total tax payable is 25,000. However, utilizing the rebate under Section 87A, the entire amount of 25,000 is not payable and taken as a rebate. Consequently, the total tax payable is nil. Now we move on to understand the concept of marginal relief. So here is where we have established that income up to 7.5 lakhs is not chargeable to tax. Now, if a user's income is 7.6 lakhs, then what essentially happens is the total tax payable on account of slab rate mechanism is rupees 26,000. So this seems a little unfair, right? Just because your income is increasing by 10,000 rupees, you end up paying 26,000 in taxes. So to remove this absurdity, what the income tax department has done is they have gone ahead and introduced the concept of marginal relief, wherein it is stated that if the income of a salary taxpayer is between 7.5 lakh to 7,77,778 rupees, then the additional outflow of tax will be based on the amount of income exceeding 7.5 lakhs. So in this case, if the income of the user is 7.6 lakhs, they will end up paying only rupees 10,000 in taxes. Excuse me. Now we will be doing a comparison between the old tax regime and the new tax regime. So first up, in comparison one, we start with income from salary under both the regimes at the same level, which is rupees 16 lakhs. Then we take a standard deduction of rupees 50,000. So now the gross total income is 15 lakh 50,000 under both the regimes. For the purposes of comparison one, for deductions, we have taken the maximum applicable deduction under the old regime in each of the sections. So housing loan interest repayment is taken at rupees 2 lakh, ATC is taken at 1,50,000, ATD, which is for your medical premium payment, rupees 50,000, ATCCD 1B, which is additional contribution to pension at rupees 50,000, and lastly, section 80CCD 2, which is employer's contribution to NPS, which is deductible under both the regimes. We have taken that as rupees 50,000. So now the total taxable income under the old tax regime is 10 lakh 50,000, and under the new tax regime it is rupees 15 lakhs. Now let us understand the taxes. Under the old tax regime, the total tax payable along with cess of 4% is 1,32,600 rupees. On the other hand, the total tax payable under the new tax regime, including cess at the rate of 4%, is 1,56,000. Now, before we do a deep dive into this, let us take a look at comparison 2. Under comparison 2, once again, we have taken the same amount of income from salary under both the regimes, which is rupees 16 lakhs. Then we have taken a standard deduction of rupees 50,000. So now the gross total income under both the regime becomes rupees 15 lakh 50,000. With respect to the deductions, in comparison to, we have taken only those deductions which are available both under the old and the new tax regime. So only employer's contribution to pension is available under both the regimes. So we have taken that at rupees 50,000. So consequently, the total taxable income under both the regimes is same at rupees 15 lakhs. Now let us understand the taxes. Under the old tax regime, the total tax payable, including cess of 4%, is 2,73,000. On the other hand, the total tax payable, including cess of 4% under the new tax regime, remains unchanged at rupees 1,56,000. Now let us sit and analyze comparison 1 and 2. So if you see in comparison 1, although the starting income from salary is same under both the regimes, if a user has utilized all the tax saving deductions, then we see that under the old tax regime, the taxable income reduces, and consequently, the total amount of tax payable also reduces. On the other hand, if you see comparison 2, where the total taxable income of the assessee is same, whether it is under the old tax regime or the new tax regime, in that case, we see that the new tax regime is more beneficial in terms of tax outflow. So what do we understand with this? The biggest takeaway one can take with this is that the new regime may be more beneficial for an individual who is expenditure intensive or who does not have a lot of tax saving deductions, or somebody who is just starting out in their career, or somebody who's a fresh graduate and is not, doing a lot of tax saving deductions and at the same time has a lot of expenditure. On the other hand, the old regime may be more beneficial to an individual who is utilizing all the tax saving opportunities available to the taxpayer. So if you're doing that, in that case, the old regime may be more beneficial. However, I want to give a caveat here to all the users stating that this is only for the educative purposes of the users here. So you need to understand that when we are talking about the choice of regime, whether the old regime or the new regime, there is no straight jacket formula, there is no one size fits all. It depends on the income of the users, the various deductions, etc. And only once we have made an assessment of all the different stream of income, all the deductions, etc., can we without doubt help the individual to understand which regime is more beneficial. Now, with this, we are done with discussing the regimes. Now we'll move on to the third segment of today's presentation, wherein we talk about who should file an ITR. Since the tax filing season is round the corner, this is a question which a lot of users have. So, as per the Income Tax Act, any person whose income is more than rupees 2,50,000 or rupees 5 lakh in the case of a senior citizen has to mandatorily file a return of income. However, if an individual's income is less than 2.5 lakh or rupees 5 lakh as the case may be, there are various other conditions one has to see. And if any of these conditions are satisfied, then a return of income has to be filed mandatorily. The conditions are as follows. If an individual has deposited more than rupees 50 lakhs in a savings bank account, or if he has deposited more than 1 crore rupees in a current bank account, or if the individual has spent more than rupees 2 lakh on foreign travel in a particular financial year, or if the electricity expenditure of such individual is more than rupees 1 lakh, or where the tax deducted at source or the tax collected at source is more than 25,000 or rupees 50,000 in the case of a senior citizen. Next, where the professional income of any person is more than rupees 10 lakh or the business turnover of the individual is more than rupees 60 lakhs. So these are all the cases wherein an individual will have to go ahead and mandatorily file a return of income. Now, the due date of filing the original return of income is 31st July 2024. So if you have filed your return of income by this date, it will be regarded as an original return of income. However, if you have missed the 31st July deadline, you still have an option to go ahead and file a belated return. A belated return means a return of income which is filed at a later point in time, a delayed return. So, the time limit for filing a delayed return is 31st December 2024. Now, this is for assessment year 24-25 only. A user also has an option of filing a revised return of income. Now, a revised return of income refers to a return of income which has first been already filed within the due dates, and after that, the taxpayer comes to know some mistakes or some anomalies in the return that they want to go ahead and revise or rectify. So, for that, the individual can go ahead and revise the return of income, and that is known as a revised return of income. Once again, the due date of filing a revised return of income is 31st December 2024 for assessment year 24-25. Lastly, if a user has still missed the 31st December deadline as well, then the income tax department has another alternative wherein a user can go ahead and file something known as an updated return of income. Now, an updated return is popularly known as the ITRU. However, there are certain things to be kept in mind if a user has to file an ITRU. First of all, an ITRU can be filed only if there is a taxpayer payable. So if you are a user who is eligible for a refund, you cannot file an ITRU and no refund will also be given to you. Secondly, if you are filing an ITRU, it is to be noted that if you have a tax payable, then whatever is the amount of tax payable, you will end up paying either 25% of the tax payable or 50% of the tax payable as a penalty for filing ITRU. Secondly, if you're filing ITRU, you will not get a lot of benefits. For example, if a user is filing ITRU, they cannot carry forward their losses, they cannot have any refunds, they cannot adjust the previous year's losses. So these are the few rules one needs to these are the few things one needs to keep in mind with respect to filing an ITRU. So as a tax expert, my advice to all the participants here is that please go ahead and file your return of income on time, because if you file your return on time, there are a lot of advantages. You can go ahead and do the revision. You can go ahead and carry forward losses. You can adjust previous year's losses. If there are any refunds to you, the refunds will be processed in time. So and also you will not miss out on any opportunities that you may have by filing the original return of income. Now let us talk about the various ITR forms. So although there is ITR 1 to 7, for individuals only ITR 1, 2, 3 and 4 are relevant. So let us understand which ITR form is for which stream of income. ITR 1 is for residential individuals who have income less than or equal to rupees 50 lakhs. Along with that, if you're an individual who has income from salary or pension or income from one house property and income from other sources, for example, dividend, interest, etc., then ITR 1 is applicable to you. Next, ITR 2 is applicable for any individual whose income is above rupees 50 lakhs, or if you're an NRI, and the income streams are as follows. If you have income from salary, income from capital gains, income from more than one house property, if you have any foreign income or foreign asset disclosures, crypto income, directorship, etc. Here is where I would like to highlight one thing. If you are an individual who is getting ESOPs of a foreign company or RSUs of a foreign company, then it is mandatory you go ahead and make that disclosure because ESOPs or RSUs of a foreign company are regarded as foreign assets. Or if you're an individual who is investing in stock markets outside India, then again ITRU becomes mandatory for you, although your income may be below rupees 50 lakhs. The reason being, if you're investing in shares outside India, they become foreign assets. Next, ITR-U is to be filed by individuals who have all the incomes of ITR-2, but alongside, they also have income from either business or profession, or they are partner in a partnership firm. Next up, we have ITR-4. Now, ITR-4 can be filed by resident individuals or a Hindu undivided family who have income less than equal to rupees 50 lakhs, but they also have presumptive income. Now, presumptive income refers to that income or that portion of the Income Tax Act wherein the Income Tax Act gives flexibility to individuals who are either professionals or in a business wherein they can go ahead and declare their income on a presumptive basis. Now, let us understand the few common mistakes that have to be avoided at the time of filing an ITR. The first and the most common mistake that we see users do is selecting an incorrect ITR form. Ever so often, we see that individuals end up filing a wrong ITR form. If they are eligible for ITR 2, they will go ahead and file an ITR 1 or vice versa. So, that is a most common mistake. Next, users miss out on calculation in case of job changes. So if you're a person who has shifted jobs during the previous financial year, then please make sure you declare the income of both your employers. It is mandatory that you go ahead and declare income from both employers. Otherwise, you will get a scrutiny notice or a defective income notice. The reason being, all the income against an individual's PAN is logged in the AIS and also Form 26AS. So if this data is with the IT department, then it is mandatory that you also go ahead and make the disclosure. Next, quoting the wrong assessment here at the time of filing the return of income or furnishing incorrect details of income. Many a times we have seen that users are not aware if a certain income has to be disclosed or not. Another common mistake, as I mentioned earlier, if you have switched jobs between the year, but you disclose the salary only of your latest employer, the current employer, then again it is known as furnishing incorrect details. So this is a very common mistake that users do, but since you have attended this session, I hope you will not do this mistake. Next, not filing return of income if tax has been deducted. This is again a very common misconception and myth that I have seen with taxpayers. They believe that, okay, tax has been deducted by my employer, tax has been deducted by my bank because they are paying me FD interest. So if tax is deducted, why do I have to file a return of income? As I mentioned earlier, if your income is about 2.5 lakh rupees or rupees 5 lakh in the case of a senior citizen, it is mandatory that you go ahead and file a return of income. It is a mandatory provision of the law. So whether tax is deducted or not deducted, to comply with the provisions of the law, you have to go ahead and file your return of income. Next, the other mistake is not disclosing an income if tax has been deducted. This is again a very pressing issue and a common mistake that we see, wherein the taxpayer says, okay, my income here from this particular income, taxes have been deducted. So if a tax is deducted, why do I go ahead and disclose it? This is absolutely wrong. This is not how your return of income is supposed to be filed. A return of income is a document which has to have a summary of your entire income for the year. And that is why it is important that you go ahead and disclose income from each and every stream, whether it is salary, capital gain, income from other sources, income from house property, income from crypto, etc. Next, not paying advance tax. So if you're a user who is required or liable to pay advance tax, please go ahead and pay the advance tax. The reason being, if you're delaying payment of taxes, you end up incurring penalty in the form of interest. Now that interest is added month on month basis. So to avoid that, it is best you do a calculation of the advance tax, if any, payable by you before 31st March, and go ahead and discharge the tax liability. Next up, failure to e-verify the return. This is very, very important and very pertinent to be noted by all the taxpayers. So e-verification of a return happens after the user has gone ahead and filed their return of income. Now we have already discussed the deadline of the return of income. E-verification is to be done within 30 days of filing the return of income. Now, what is e-verification? As the name says, it is simply you electronically verifying that you have filed the return of income. Why this is important? If you don't e-verify the return of income within 30 days of the date of filing, then what happens is your return will be invalidated or it will be regarded as an invalid return. That is to say, the entire filing will become void ab initio. So all the hard work that you must have done to go ahead and read the provision, acquaint yourself with the tax treatment and go ahead and file the return of income, all of that will go down the drain if you don't e-verify the return in a timely manner. So typically what I advise all my clients is that please e-verify your return of income immediately after you're done with the filing. It is a very simple step. The moment you go ahead and file your return of income, automatically a pop-up comes, whether it is on the IT portal or also the cleartax platform if you're using the platform to file your return of income, wherein an option will come asking you to e-verify the return. So there you have to get a OTP on your Aadhaar registered mobile number. Once you get the OTP, simply key in the OTP in the section and click on e-verify and you're done with e-verification. So your return filing journey is complete only once you e-verify the return. So with this, our journey also for today has come to an end. Thank you for being such a wonderful audience. I will open the floor for questions now. So if you have a question, please raise your hand, unmute yourself and ask the question, and I'll be more than happy to take down the question and answer it for you. I also have one sincere request with all the participants here. In the interest that all the participants get equal opportunity to ask the question, I request each participant to please restrict their questions to only one per participant. Or you also have an option to put down questions in the chat box and I will take up the questions. Okay, we have a person, Miss Soumyadeep Chakrabarti, who wants to ask a question. Soumyadeep, please go ahead and unmute yourself and ask the question. Soumyadeep, please go ahead and ask your question. I request the host to please unmute, please help the attendees with asking us the question. I think you have to give them the permission to go ahead and unmute themselves. We have a question from Mr. Rajesh. Electricity bill rupees 1 lakh, is it for 1 month or the whole year? Mr. Rajesh, the electricity bill is on a per annum basis. So if in any financial year your electricity bill is more than rupees 1 lakh, you have to file the return of income. If you all have any questions, please put them in the Q&A box or the chat box. We are, taking a look at the tax chat box now. You can go ahead and ask all your questions. Okay, we have another question. Customer sell holding of rupees 40 lakhs and he wants to buy house. Is it taxable or not? So here the question is not very clear. If you could, tell me what exactly is the amount item of sale. First of all, you need to make sure that it is a long-term capital asset, and the long-term capital asset can either be a house or any other long-term capital asset. So if you're once you have sold that, and if this gain of rupees 40 lakhs, if it is a long-term capital gain, then yes, if you're investing in a house, either by way of purchase or by way of construction, you can go ahead and claim the exemption. We will wait for another 2 minutes and we will see the questions. If we don't have any questions, then we will, call it a day. So please, if you have any questions, put them in the chat box or the Q&A, and we'll take that up.
So, Miss Megha, I believe there are no more queries, and we should wrap up the session now.
Sure. Thank you so much, Simran. Thank you everyone for being such a wonderful audience today. And we look forward to, helping you file your return of income through ClearTax. So yeah, thank you so much, everyone.
Thank you, Miss Megha, and thanks everyone for joining the session. Have a great day.